welcome back to another Random Gleanings. He is Chris. I am Jesse. Chris, we're really going to kind of zero in on international markets today.
Yep.
But before we go long into other parts of the world, why don't you catch us up real quick on some what's been a good year so far?
S&P's up about 9. We did have a little correction in April, and it's starting to rebound off of Apple's earnings, which is good. Other things to note, the international side and emerging market side are up about 6.5 year to date. Gold's actually up 12.25 year to date through this morning. Let's zero in on international. Usually a rising dollar, and the dollar's been rising basically since December of last year relative to other currencies.
Sure.
Usually that's a headwind for the rest of the world. But, I mean, again, you see developed international and EM or emerging markets up about 6.5 year to date. And that's kind of interesting to me. What's going on there? You pulled some charts about usually the upside downness of how that works.
Yeah. So where I went to a pretty dramatic example was back to July of 2014. The dollar started to strengthen against, like you said, other international currencies. And you can see the green line, the dollar is rising.
And emerging markets are falling.
Through the start of 2017, emerging markets are falling. And then
next chart,
that relationship changed. Dollar starts to weaken against international markets.
And EM crushes it.
And EM just dominates. That's exactly right. So like you said, it's been unusual this year that we've seen international markets, emerging markets doing well in the face of a strengthening dollar. Right.
Yep. So why? That's the big question. And, one answer may be, and don't tune out after we say this, it may be declining global inflation, but here's the thing. When you start to get under the surface of the price of international markets relative to the U.S., they're really, really stretched. And I mean, you could say they're cheap, okay? Look, they are cheap, but those areas are more industrial than they are technology, right? So, I mean, if you just subscribe to, technology's the only game in town, okay? Well, that depends. How expensive is the technology and how cheap is the industrial stuff?
I mean, for sure. Yeah, and I think that the inflation story has something to do, right? If only because in 23 we still had high inflation, but it was coming down at a quick pace for U.S., but businesses were still reaping the benefits of higher prices, right? That they were able to have raised in a high inflation environment. Maybe that's, like you said, maybe that's part of the story there.
Well, let's look at the pricing of the rest of the world relative to the U.S. So in this chart, you'll see down in orange that we are -2 standard deviations below in terms of the price to earnings on everything else in the world besides the U.S. versus the U.S. Okay, so what's a standard deviation? That sounds pretty geeky, right? So
it is.
It is geeky, that's right. So it's kind of random. Let's look at the bell curve, right?
Yeah.
So the middle of the bell curve is your average annual return.
That's right.
Okay.
Yep.
And -2 standard deviations would explain like 95 out of 100 outcomes. Okay. So I kind of think of this in terms of the potential for a reversion to the mean at some point.
Oh, yeah.
Or look at this next picture, which may be a little hyperbolic. Okay. Mm-hmm. But if you think about regression to the mean, the average annual return over time, at some point, that rubber band gets stretched and starts going back
that's
the
just
other
it.
direction.
And the further it gets stretched, the more likely it is to come back together.
Right. And look, I'm not saying that's going to happen in any short period of time.
Sure.
Okay. At all. But you do have to acknowledge, and it's been this way for a little while now, you do have to acknowledge that it's not expensive. Other things to consider. Why else might it be acting the way it is in the face of sort of a headwind, a rising dollar? Mm-hmm. Well, Warren Buffett had his
annual shareholder
meeting last week, and one of the things he talked about is he didn't see a lot of values around. Okay, well, the international side, I mean, it's cheaper, and the dividend yield of everything else in the world besides the U.S. is double.
More than double, yeah.
Double that
Yeah.
of the United States. Okay.
So cheaper, and you're getting paid to sit in that, in that holding.
So if you value the notion of dividends as a component of your total return, you would want to look and see where that is. Well, on the international side, it's double. It's not just the international side. It's not just developed. It's the entire rest of the world.
That's right. Yeah.
Okay. So Yeah, you can't. I don't think you can ignore that, especially if we go through a period of maybe okay earnings growth.
Yeah, it's not a recommendation here, but it is. You have to notice that there's a difference between these two markets right now, right?
That's right.
And what you're about to show, I'm excited because it shows that there's been some performance and outperformance from the international side to the U.S. side over long stretches of time.
Right.
So walk us through this real quick.
Yeah. So this chart's from August of 2001 through January 1st of 2014. And what you'll see is during that time period, both the U.S. and the rest of the world had roughly the same performance. Okay, plus 55, plus 60% right in there on a price performance basis. Okay. Now, here's what's interesting. On October 31st of 2007, the international side was up 102.4%, and the U.S. was up 26.6%.
4x over, again, a long stretch.
That's right.
It was outperforming for, what is that, 5-6 years?
Yeah,
right? So,
that's exactly right. And was stretched to the notion of about a 75% outperformance towards the international side versus the U.S. side. So let's look at it since 2014. What you'll see is that the international side, the developed international side on a price basis, not including dividends, is up a whopping 15%. And the S&P 500 is up 170% in that time period.
Yeah.
That's 155% outperformance during that time period. And you can make the argument all you want that, technology's better, right? Okay, fine. Technology is what got you that return, and that's fantastic.
That's right.
But the PE multiple of the United States is definitely higher than the international side. The dividend is half of what it is. So if you value the notion that dividends are any component of total return over the long run, then you've got to at least acknowledge that the rest of the world is cheaper. And
or if you're a value shopper, right? at least acknowledge that, hey, these two milks are basically the same product, right? So if one's cheaper, then maybe I ought to consider it, right? So I think that there's something going on there too. So,
So this is not a recommendation just to go headlong in the international, but I mean you've got to be paying attention to it and ultimately at least be considering it as a component to the portfolio. And if you see a breakout in the face of a stronger dollar, to me, that's pretty interesting. I mean, at least on a shorter term momentum standpoint, it's pretty interesting.
Yeah, I mean, I guess what you're implying there is that if anything were to break the strength of the dollar, you would expect, at least historically, that the continuation of the strength in international markets would probably only pick up the pace.
You would think. Right. Again, it's not a recommendation. It's just, just pay attention to it.
Yeah.
So we finished, turning to what we're watching, I'll just share with you, we finished Tokyo Vice. Awesome.
Yeah.
Highly recommend it.
All right.
Highly recommend
it.
Get
to it.
Don't know what we're going to do yet. The Mrs. doesn't want to watch Mr. and Mrs. Smith, which I really dug the first episode of that.
Good.
So anyway.
Yeah. Soccer tournament for me this weekend, so little TV time. But,
Gotcha. Yeah. Good luck with that.
Yeah.
It's May-cember. And it's very busy.
That's right.
Without the Christmas presents.
That's right.
Thanks, friends, as always, for watching. We're grateful to you. Please do click the subscribe button. Click the bell if you want to be notified when we post. And please do feel free to share this with a friend. It's good information from a 401k standpoint, from your own investment portfolio standpoint, just something to consider. Thanks, as always.